welcome back. This is the corporate raising panel, and we have two great speakers, Michelle Lowry from Drexel, and we have Olga, I think it's Itenberg, but she'll correct me if I'm wrong, from the Securities and Exchange Commission. We're going to have a dialogue today, in particular on some of the new things that are happening in the IPO markets or the capital raising markets, because Michelle and I have an expertise in the going public. We're going to go ahead and focus a little bit more on that in the equity markets in particular. So we're going to begin by allowing Michelle and Olga to introduce themselves. So Michelle.
Thank you, Kathleen. I am Michelle Lowry. I'm a finance professor at Drexel, and I also run a corporate governance institute that's hosted through Drexel. And I do research on IPOs and corporate governance, primarily a lot of things on differences in corporate governance between young companies and more mature companies. Thanks.
Hi, everyone, and my name is Olga Itenberg. I'm at the Securities and Exchange Commission. I'm a financial economist at the Office of Corporate Finance. As such, I work on economic analysis for various rulemakings, kind of spanning corporate disclosure, corporate governance, proxy voting, and capital raising.
And you want to give your disclaimer now?
Yes, I do. So a standard disclaimer applies. The views expressed here today are my own and do not necessarily reflect those of the commission, the commissioners, or other members of the commission staff.
Wonderful. So if you don't know me, I'm Kathleen Hanley. I'm a professor at Lehigh University, and I have been at the commission as well as been in academia. So I'm excited today about the panel. We're going to kick it off by talking about SPAC, special purpose acquisition vehicles. And I don't know why it's a C, but someone will tell me that. Michelle is going to share some information about it because these have become enormously popular if you read the press. And you know, they're more complicated, a little bit different. So she's going to tell us what are they and how do they work.
Okay, thank you, Kathleen, and thank you for inviting me to participate in this. So like Kathleen said, we thought it would be helpful just to provide an overview, and that can serve as a bit of a basis for the panel discussion going forward. So let me start with a timeline of a typical SPAC. Things start with the SPAC IPO. That's when the shell company goes public. That shell company then has a maximum of 18 to 24 months to find a private company to purchase. And that later point is what's generally referred to as the merger state of things. At the time of the IPO, investors buy units in the SPAC that are almost always priced at $10 per unit, where the unit consists of common stock and a warrant. The proceeds from those units are then placed into an escrow account where they're valued at $10 per share. Now, each SPAC has a sponsor. That's typically a hedge fund, an industry executive. You might have heard instances where a celebrity is also a sponsor. This is the entity or person that is making the SPAC happen. And as compensation for that, they retain 20% of SPAC shares. Okay, so to clarify, they're not purchasing those shares, they are getting those shares as compensation for sponsoring the SPAC. In addition, the sponsor also buys warrants for $1.50 each. Those warrants are what's used to pay the first installment to underwriters, where the underwriters are getting 2% of proceeds. So that's the basic set of things that's happening at the time of the SPAC IPO. Fast forward to the time of the merger, what happens? So first, investors vote either for or against the merger. Second, and independent from the vote, the investors decide whether to redeem or keep their shares. If they redeem their shares, they can redeem them for the full $10 they paid plus interest, and that's going to be important. And second, and also independent from the other two things they do, they can either keep or sell the warrant. So what do we have? We have these proceeds from the IPO where investors bought units at $10 per unit. Now, in some of those cases, the investors have redeemed those shares. Whatever proceeds still remain, net of redemptions, are used for acquisition of the private company. In many cases, investors redeem many of their shares, so there's not enough money left to buy that private company. That's where a PIPE comes in. A PIPE is a private investment in public equity. Hedge funds are very typical investors in these PIPEs, and the PIPE is to obtain capital to offset those redemptions so that the SPAC has enough to buy the private company. And finally, at completion of the merger, if the underwriter gets an additional 3.5% of proceeds, and after 5 years, those warrants become exercisable typically at a price of $11.50. Okay, so let's quickly highlight two things that are often the focus of discussion in SPACs. First is the problem of high costs. So let's look at this schematic one more time. What are the source of these costs? First, the sponsor retaining those 20% of SPAC shares. That's a lot of dilution to this new company. Second, the investors who can independently decide to redeem their shares. And remember, when they redeem their shares, they get the full price they paid, the $10 per share plus interest. They can redeem their shares and keep the warrant. They're effectively getting a warrant for free, an additional source of dilution. And finally, the underwriter gets 5.5% of proceeds. You put all those together, and the working paper by Jay Ritter and co-authors finds that the total cost of a SPAC as a fraction of proceeds raised is over 50%. That's huge, and about 3 times as much as a traditional IPO. Finally, the second problem I want to highlight is that of what I'm going to call bad incentives. Let's just pick a few things here. Let's think about the investors. Investors have the option to vote for the merger, even if they think that merger is a negative NPV activity. They can vote for the merger. They can then redeem their shares for full value and keep the warrant. They're getting a free warrant. It's a free option. Having the availability of that free option gives them an incentive to vote for a merger, even if it's negative NPV. The sponsor retains 20% of the SPAC shares. Those shares are worth nothing if they don't complete a merger. Again, that's an added incentive from the perspective of the sponsor to complete a merger, even if it is not value increasing. And finally, from the perspective of the underwriter only gets that second installment of fees if the merger is completed. So you put all these things together, it's perhaps not surprising that post-merger returns are quite negative, an average return of negative 15% over the next year. And those are estimates by, again, the same working paper by Jay Ritter and co-authors. What's effectively going on is you have this very high dilution from warrants and redemptions that are going to low de-SPAC returns, that's returns after the merger, that represents a transfer vis-a-vis the high return between the IPO and acquisition announcement, where those investors are effectively getting an average return of over 9%, akin to a default-free convertible bond. The good news, and I know this is something we're going to talk about more in the panel, is some of these dynamics do appear to be evolving. We're seeing that more recent SPACs have fewer such transfers, that is less dilution. They have different contract terms. So there is evidence that the market is evolving to a more stable equilibrium. And with that, let me stop there and turn it over to Olga, who I think is going to talk about maybe what the SEC is doing here and the regulatory pressure that is also contributing to changes in this market. Thanks.
Thanks, Michelle. So it is differently from how Michelle phrased it. I can't talk about what the SEC is doing. What I can talk about what SEC has kind of room to do and where financial regulation may play a role in this market. What are the possible concerns that regulators may have in this market? And when thinking just, is there a problem? And do financial regulators have room, have space, have authority to fix such a problem? I often find it really useful to kind of go back to the fundamental. And with the fundamental being, what is the mission of the Securities and Exchange Commission? And the mission is 3-pronged. And the 3 prongs are: 1, to protect investors; 2, to maintain fair, orderly, and efficient markets. And 3, to facilitate capital formation. And oftentimes, when we think about financial regulation, some of these prongs are kind of in tension with one another. And in particular with the SPAC market. And here, the way I view it is that, here, the 2 prongs that are kind of in conflict are facilitating capital formation and protecting investors. Because SPACs may actually serve a legitimate purpose in allowing companies to raise capital, facilitating economic growth and so forth. But at the same time, there's this question of, are investors aware of what they're getting into? Are there potential harms that can accrue to investors in the space? So when thinking about concerns, I think there's several. So let me just highlight some of them. And along with these concerns, I can kind of speak a little bit about where there's potential room for regulation. One is kind of a fundamental question of, do investors understand what they're investing in? Okay. And these are complex transactions. And there's a lot of retail interest and involvement, retail investor interest and involvement here. So the question is, could the complexity here lead to a misunderstanding of the value of the investment? Kind of as an example, do investors fully anticipate the dilution that may face as a result of these sponsor promotes, they're called, this 20% that Michelle spoke about that accrues to the sponsor? Also, as a result of additional PIPE investments at the stage of the actual business combination, the de-SPAC stage. And in addition, so kind of some other dilution things like warrant exercises and the like. So it's unclear, if we believe that investors fully understand all of these complicated things that may affect the value of their investments over the next several years, then there's no room for regulation. However, if they do not, potentially there's room for additional disclosure. And this has been kind of proposed as one of the ways to inform investors. So disclosure at the IPO stage may involve potential contingencies, if a PIPE investment at the acquisition stage is, of a certain amount, how will your shares as a $10 investor, how will the value of that will be diluted? So additional disclosure is kind of what the key here. Another one is there's this concern that their SPACs at the de-SPAC stage, at the state of the acquisition, look very much like IPOs in that you have a private operating company becoming a public operating company. In addition, many investors in this new public operating company are not going to be the initial investors in the SPAC. As Michelle mentioned, some of them are going to redeem their shares. So the question arises, so if they're kind of similar, should the disclosures be similar as well? And currently there's some differences in the disclosures that companies have to provide here. Of particular concern has been this issue of how does management express forward-looking statements? Whether that's a concern or not kind of has yet to, I think, be born in the kind of the courts, but the fundamental issue is the following. When speaking about the future, securities laws and courts have interpreted projection statements about the future differently, and have sheltered management from liability when identifying future statements as such, and therefore, saying this is a future forward-looking statement, but we believe sales are going to grow by 20%. So to the extent that doesn't borne out, they may have lost some liability unless you're in the merger transaction. Now, of course, we have to take a step back and think about, well, if investors realize that management is not liable for these statements, are they going to interpret this as cheap talk? So maybe, there's not really an issue here, but to the extent that these, the treatment of disclosures and the types of disclosures are slightly different at this stage, they're potentially, to the extent that we think this may be a concern, there's room for regulation and kind of making these similar. A third one, and these are in no particular order, I think, is conflicts of interest. And Michelle spoke a little bit about this. The incentive to actually go through the merger may be misaligned with the shareholders' incentives. Here, I think, once again, additional disclosure could probably play a role, although it's a little bit difficult because it's a little bit difficult to kind of foresee what the disclosure here will be. And the last thing, or I mean, there's many concerns, but the last thing I would like to talk about here is, the case of specific sponsors. And this is something that, and by specific sponsors, I mean well-known celebrity sponsors. And these are, so we've seen SPACs that have been sponsored by celebrity athletes, celebrity actors and singers. And the concern is, if you're an investor in the SPAC, before it acquires a company, really the only information you have are, really what you have to rely on is who the sponsor is. And that's kind of really the only signal you have of the future potential acquisition opportunity and the quality that may have. So the concern is that as investors are recognizing this name, they're potentially going to attribute some value that is not warranted to the SPAC. And here, the role of the SEC, I think, SEC has has done some things in the space, and I think rightfully, I don't think there's much room for regulation, but here's a space where there's a lot of room for investor education. So SEC has kind of released some cautionary statements regarding, just because the SPAC is sponsored by celebrity client, celebrity sponsor, it's not necessarily the case that it's kind of like a valuable SPAC, and there's risks associated with investing in SPACs.
Great.
So I'll wrap here and open it up.
So I'm always interested in this because, I had a long history with the SEC. I was there as a graduate student and then a couple times afterwards. But these used to be called blank check companies, if I remember correctly. So they've been around for a very, 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 very long time. And so I'm just wondering, why do you think there's this uptake now? I mean, it seems like blank check companies you wanted to avoid. They were sort of, they weren't pump and dump, but they weren't too far off, right? That these were companies that you were marketed to unsophisticated investors who didn't know what they were doing. And all of a sudden now SPACs are like this, there were like 300 of them, recently. I mean, they're so popular. So what changed to make these companies, this form of offering more mainstream, let's say?
Yeah. So this is a great observation. SPACs are not new. I would say they're kind of like a modern take, let's say, on what was a blank check company of the 1980s. And the way to think about them really is they're blank check companies with additional safety features built in for investor protection. Just a little bit of history. So you had these blank check companies in the 1980s, same thing, shell companies who just raise money in an IPO with the sole purpose of acquiring a company in a couple of years. And there's been a lot of fraud around them. And the fundamental here was that there was not, there's no assets in this company. There's no employees. And therefore it was, you had these insiders touting the value of potential acquisition. Prices would rise, and then investors realize that they're actually investing in something completely worthless. So this was like a big issue in the 1980s. It raised a lot of concern from Congress about this, and which led to a kind of pretty significant regulation in the space, which severely limited this kind of activity. Now, so Congress votes on laws and they, write laws, SEC figures out how to write rules to implement those laws. So while the SEC was writing these rules, there was still kind of this fundamental understanding, like it's probably bad to kill blank check companies altogether because there might be a legitimate use for that. So while the SEC is writing those laws, there were a couple of creative kind of lawyers and underwriters who said, okay, well, can we develop something different? Can we develop like something that's kind of similar, but has some of the investor protections built in, such that the SEC will be okay, we'll appease the SEC and they'll kind of stay off our backs. And in fact, that's what they effectively did. Like while the SEC was writing in the rules, a group of these lawyers and underwriters created SPACs, and effectively SPACs are outside of the rules that the SEC were writing, but because they adopted a lot of the prongs of that regulation, SEC was like, okay, we'll let you go forward. And what were those prongs? What separates a SPAC from a prior blank check company. And I effectively think there's like 3 key things. And one of them is that, so the fact that the use of IPO funds is limited. So you have to put it in an escrow account or trust account and leave it there. That's one. The second one is it required shareholders to vote on the acquisition, which was not available before. And 3, as Michelle noted, it allowed shareholders to offload, to redeem their position at the acquisition stage. So, so the benefit of this, the whole kind of thing is once investors actually know what the company is investing in, they have options. So this is how SPACs evolved. But can I just take a little detour because we're in a PhD session? I think it kind of highlights when thinking about financial regulation and using financial regulation in research, we have to be a little bit careful that these are not exogenous shocks. Here you have an example in which financial regulation developed as a result of a problem in the market. Financial innovation, kind of development of SPACs, came as hand in hand with the financial regulation, and a lot of details about what the regulation will have were kind of not news. So I think you have to be, when thinking about financial regulation, you have to be really careful when using it in event studies and thinking about timing of that. So it just kind of highlights that.
I would also love to jump on something you said, and I'm going to put it under the bucket unintended, perhaps, effects of regulation, because you mentioned the requirements, right? The changes that resulted in SPACs today. And 2 of them were that you have to vote and that you can redeem shares. And somewhat ironically, it's this combination of things that are contributing to a lot of the, call them problems, or certainly very, very poor performance and conflict of interest that we see today. Because investors have the option to vote for the SPAC, even if they think it is or vote for the merger, excuse me, even if they think it is an absolutely horrible merger. Yep. And in fact, they're incentivized to do exactly this. They're incentivized to vote for essentially any merger, then to redeem their shares and to keep the warrant because they're getting the warrant for free. And so by not connecting that voting decision with whether they're keeping or redeeming their shares, you're ending up with a very kind of odd equilibrium that we're seeing now.
So Michelle, I wanted to add, sort of piggyback upon this point and, think about the type of firm that chooses to be acquired by a SPAC. So, when you think about traditional IPO firms versus SPAC IPOs, the question came in about whether SPACs are regulatory arbitrage. Maybe that's one reason why firms would decide to go the SPAC route. But you have some thoughts about, firms looking at the menu of options, and we're just going to put those 2 on the table for now. We'll talk about direct listings more toward the end. Sure. What would be some considerations the firm would have to think about in choosing one over the other?
It's a great question. I think there are a number of things. So one of the factors about SPACs that's touted very frequently, in my opinion, a bit misleadingly so, but in any case, is the speed to market. And so private companies are notoriously just nervous, right? And rightfully so. We know that if the market crashes, 90-some-odd% of IPOs are going to be withdrawn. There's just a lot of uncertainty about that. And so for a typical timeline for a private company to get ready to go public, you're talking about 1 to 2 years by the time you get all your ducks in order, okay? Your financial statements, your right advisors, your board set up, blah, 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 blah. With a SPAC, they advertise that you can do this in 3 to 6 months, and we're going to guarantee what price we're going to provide to you because it's a merger and we can set that price ahead of time. And so it gives this sort of appearance of much less uncertainty. Now, in reality, the shorter timeline actually doesn't end up playing out that way in many cases, because the reality is companies do need to get their financial statements in order, and they do need to get their governance in order. But private companies, especially small private companies, they very often lack the advisors that have all of the relevant knowledge. And so if they have a sponsor, I have talked to private company executives, and they say they're getting emails from sponsor SPACs, literally multiple emails a week saying, I'll take you public in a SPAC. And if you don't know what you're doing, if you don't have the expertise, you say, great, I can come to public, come to market now and go public. That seems to provide a lot of advantages. So I think it's, Kathleen, to get back to your question, a variety of factors. It is private companies that think they do want to go public and are not sure what the market is going to look like 2 years from now, and they think, I'm going to jump on it now. Some companies state that the ability to make forward-looking statements, which is something Olga talked about, is also appealing. So if you do not have positive even revenues now, your ability to provide a forecast of what's coming down the pike can be seen as valuable. And then finally, I think something that's increasingly playing a role is, who is the sponsor in this SPAC? Because if the sponsor is somebody with a lot of industry expertise, this is something that can rightfully, for very good reasons, make a SPAC a preferable alternative to a traditional IPO, because you are sort of signing up with somebody that's going to have an equity position in your company, that is going to sit on the board. And if they have a lot of expertise in your industry, then that might very much be the advantageous way to proceed.
Terrific. So, SPACs were going gangbusters. Everybody thought this was the new thing, was going to last forever, but we've seen in the last few months a real fall off. I mean, this is sort of for those of you who have not been around as long as I have, this is always the trend. There's something new and exciting, and then oftentimes it doesn't have any legs and ends up going, going away. But what do you think, for both Olga and Michelle, what do you think is some of the reasons behind the decline in the SPACs? And do we think this is going to be something that the decline will be fixed, or do you think it's just a facet of maybe a bubble type of situation? Olga, you want to?
We both have a lot of thoughts on this. Olga, you want to go first, and then I'll jump in.
So I think it's probably, I agree probably with a widely held view that the numbers are just seem large and probably larger than what is kind of sustainable in the long term. There's this notion of there's so many SPACs, there's not enough targets. We also have to consider the fact that the more scarce the targets are, that also changes the bargaining, right, in the acquisition process. So are they
that a little bit more?
Yeah, of course. So if there's very few targets, you have multiple SPACs going after these very few targets, the targets potentially have more room to kind of negotiate better valuations for themselves. And that, of course, cuts into this whole the potential upside of investing early in a SPAC, because the whole point is, you eventually acquire something really valuable. And how valuable that is will depend on the price that you pay for it. So I think there's this concern here. I think I'm of the view that kind of in the long, we're converging to something. I don't think we're converging to something where SPACs are going to be completely eliminated. I just think it's going to be the activity is going to be lower than it is now to be sustainable in the long term. In general, there's been very little innovation in the IPO space, and it seems like there was kind of demand for these new vehicles for companies to go public, both from the investor side and from the company side.
So shockingly, I 110% agree with all of that. The only thing I would add to that is, when the SPACs first started coming, we hadn't seen any de-SPAC periods, right? Like, we hadn't observed exactly how horribly they tend to do on average after the acquisition. We now have growing evidence of exactly how horrible that is, and that makes them a harder sell at the beginning. So rightfully so, right? This is the market learning, and this is what we would expect. So I think the very poor performance de-SPAC is contributing to also just an additional factor that's contributing to fewer SPACs now. And as these contract terms start to evolve, which we're starting to see, so if you compare contract terms in more recent SPACs to those from a few years ago, you see the contract terms changing in ways that should shift this. So I talked in the few slides I put up about this transfer from de-SPAC investors to the initial investors in the IPO. The contract terms are changing in ways that mitigate that transfer. If those contract terms sort of can change enough so that we see something where everybody's earning a fair return, I think that's the point where you start to see a more stable equilibrium of SPACs going forward.
So I want to bring out, Michelle, to you the point that Olga raised, that there is this demand from both investors and firms to change the traditional IPO process. Can you give us some thoughts about what is broken or wrong with the traditional IPO process that necessitated some of the changes that we're seeing in that market?
Sure. So the traditional IPO process, as I'm sure many of you are aware, is really sort of controlled by a relatively small number of gatekeepers, which I would think of as the big investment banks. You know, if you want to go public for umpteen years, you have every incentive in the world to go public with the investment bank that has the highest ranked analyst in your industry. And that bank is very likely to be one of the top tier investment banks. That gives that bank a lot of power over you, right? If you come and say, I think I should be priced at $15 a share, and the bank says, no, I think you should be priced at $10 a share because I want to allocate underpriced shares in your company to my clients, then the company says, you know, oh, okay, I'll go public at $10 a share because my only other option is to walk away to another investment bank that's going to do the same thing to me. So, you know, sort of this evidence in, I think, in academics and more widely than that, even, that the big investment banks almost have a cartel over these companies. That's a hard thing to break, right? So if you go back to the late 90s and early 2000s, you saw pressure for an alternative way to companies to go public. And W.R. Hambrick, which was an investment bank, came out and said, we will enable you guys to go public via auctions. And this will be great. You're not going to have to pay huge fees to an investment bank. You can just do an auction. The price will be determined by where supply meets demand. This is sort of everything that we as economists should hope for. And we saw a grand total of, I don't remember the exact number, 20 companies take advantage of this, something like that, you know, and it totally died out and it went nowhere. And to me and a number of other sort of IPO academics, this looked incredibly frustrating, right? You know, why didn't this take off more? And so those same pressures exist today. Like the pressures and the problems and the frictions haven't changed. I think the $1 million question is, have the characteristics of the market changed enough today compared to 20 years ago, such that we can now make these alternative means of going public succeed? So, you know, what has changed? You can think about the way that the internet has provided individual investors with more information. You can think about alternative means of getting IPO shares through the different types of brokers that exist today. You can think of the many ways that, you know, retail investors are, at least in some dimensions, getting more power. You know, how is that going to play out going forward? I think we're going to get into direct listings, maybe. I don't know if I should jump into that now or
Go ahead.
wait. So direct listings are a means for companies to, well, there's sort of multiple types, but the most of the cases that we've seen so far are companies just listing existing shares. So they are not actually raising new capital. That is becoming possible, but sort of hold that off for a minute. So in a direct listing, a company does not hire an investment bank to market the IPO. It does not pay the large investment bank fees. It should be, in theory, it's like an auction in many ways, right? You are just listing your shares and the shares start trading at the price where supply equals demand. So there's been a lot of debate as to whether direct listings are going to take over traditional IPOs, because if these are cheaper ways of going public, then companies should optimally choose this alternative way. I personally am incredibly skeptical that direct listings will ever take over traditional IPOs. If you look at the types of companies that have done direct listings so far, they are almost all companies with what I would call very high household name recognition. These are companies that people know. They are Spotify, they are Coinbase, they're a big gaming company. And so those types of companies don't rely on the investment bank to tell the world about their company, because everybody already knows a lot about the company and the media is already covering it. So going forward, I think it'll be interesting to see the extent to which these direct listings start getting more market share among that set of companies. Like, I think that's where we're going to see the most movement first.
Olga, this raises some issues that Michelle mentioned about retail investors playing in the IPO space or capital formation space. They were generally not a large participant in the market because of the ability of the underwriter to allocate shares to large institutional clients. And we've been seeing lately that retail investors have moved markets in ways that may be outside of fundamentals, for example. From the SEC's perspective, what are some concerns about having such a large retail participation in particularly IPOs where information is not as readily available to the investor? Are there concerns about these SPACs and others of those investors being taken advantage of?
So yes, so exactly. So this is a fundamental concern of the commission. And this is something I kind of touched on a little bit about, where I think the room for regulation here is really about thinking about disclosure. Like, do these investors actually understand? Some of this, just kind of piggyback off of what Michelle said, I think we just need to take a step back and really think about, are these different ways of going public? Are they complements or are they substitutes? I think there's a lot of evidence that they're going to end up being complements here. It looks like there's going to be a type of separation where certain companies go public via direct listing. And by the way, just to caveat something, so at this point, companies are allowed to go public via direct listing and sell primary shares. The commission approved an order for the New York Stock Exchange listed companies to be able to do this in December, and for NASDAQ companies to be able to do this just a couple of months ago. So that now it kind of looks much more like an IPO, where the company, in addition to selling shares, is raising new money. When thinking about both retail investors, but also institutional investors, I think this question of is sufficient due diligence being done in both the SPAC instances, but also in the direct listing instances? The question here, if it's not being done, is there room for regulation to require kind of additional liability to financial advisors to make sure due diligence is being done? So this is kind of concern. Another concern, which would affect retail investors, but also institutional investors in the direct listing space in particularly, has been raised, and is this concern of traceability. And this is something that was raised by some of the critics of the direct listing proposal, NASDAQ and New York Stock Exchange proposal. And there, the issue is that if there's a misstatement if there's false information in a registration statement, shareholders can sue and recover some money. The courts have relied on this question of, can the shares bought be actually traced to the registration statement? One quirk about direct listings is when a company sells both secondary shares and primary shares, as a new shareholder, I can't actually know that I'm buying new shares being issued or I'm buying shares from insiders. And therefore, the question is, does that put limitations on, in the cases of wrongdoing and misstatement, does it put limitation on what shareholders can recover?
Olga, but isn't that the same thing in a regular IPO? I don't know.
Yeah, so this is
if I-
actually a really good question. So these issues exist in a regular IPO. The difference is like, so in a regular IPO, you have lockups. So because insiders often are prevented from selling shares for a particular point of time, it's much easier to prove that the share that you purchased was in real, it can be traced to the registration statement.
Well, they do offer secondary shares. Many IPOs offer.
I mean, so
this
it has been, you know, so
these
the
letters.
extent, yeah.
Very, I'm not a lawyer, but I did find that these arguments were not really holding
Compelling.
water. But what I don't, maybe you could explain to everybody else, is that when you do a traditional underwriting or a SPAC, you have a uniform price that you must issue the shares, right? So how does that work in a direct listing where, you know, you're putting it out into the market? So will you and I buy shares, particularly primary shares? Is that allowed price discrimination to some extent to occur among investors? How does that?
Okay, so before the auction is conducted, in the registration statement, the company insiders actually have to create bounds for a price. They usually hire a financial advisor to be able to establish bounds. The transaction will not go through unless the auction price is going to be within these bounds.
In a direct listing?
Yeah.
I thought the bounds must be really wide, right? Because typically the price is opening up at like 37% above, I think, the average.
Yeah, so this has been like a kind of a change between the New York Stock Exchange approval and the NASDAQ approval. NASDAQ is a little more flexible where it allows it to go plus or minus kind of 20% outside of the bounds. But there's still this, so if for the New York Stock Exchange approval, if it doesn't go within the bounds, they have to redo the auction, reissue, kind of like append a registration statement.
Is this only when only when primary shares are being offered?
Yeah, that's right.
I see. Okay.
So maybe that's the difference. Yeah, maybe that's why I'm confusing you.
Because we haven't had that many, right? Where
exactly.
Have been offered, and the average. So just to step back, maybe to make sure everybody's kind of on the same page, in the direct listings, they issue sort of the exchange in conjunction with some advisors, some banks, publishes this reference price, where the reference price is based on largely what the shares have traded at in the private market over the past quarter or so. So if they did a fundraise, or if there were some shares that were traded on, you know, a smaller exchange, something like that, that sets sort of an expectation for approximately what one might expect this stock to open at. But at least according to the data that I'd seen across a number of the big direct listings, so these were direct listings where there were no primary shares being offered, on average, the opening price was 37% above the reference price. It sort of calls into question, you know, exactly how informative is
how
that
valuable
price?
is this additional liquidity?
Yeah, like what is this really telling me, right?
But Michelle, what does an insider who's selling their shares, what do they get? Do they get a VWAPs or a value weighted average price? Or,
so that's one of the sort of fascinating things about direct listing, is that there's no price discrimination. Like everybody's getting the same price. There's none, like in a traditional IPO, you have the institutions are getting to buy at the offer price, and the insiders who are selling at the offer price. And then the retail investors who typically don't get allocations are buying at a much, much higher price, which is sort of an average of 17% above the offer price. In a direct listing, there's none of that. Like everybody's getting the same thing. I mean, accounting for whatever volatility happens during the first day, but it really, I think, opens up all kinds of just fascinating questions for those of you kind of interested, you know, on the research front. How you could think of many different ways this might affect the company. Like I could go back to IPO research, right, and think about, you know, what's the value of having a long-term investor in your company if you are a private firm who's going public for the first time. And there's lots of evidence that in traditional IPOs, banks are being very diligent about placing some subset of shares with investors who are sort of making this promise to be long-term investors in the company. How does that change if instead you have no control over what investors are buying your shares? You could imagine some models where it makes no difference at all. You could imagine other models at the other end of the spectrum where you have a meme stock phenomenon going on and it's sort of, everything is very, very different. So I think thinking about the ways that shares get placed or who is your shareholder base in these different types of IPOs and how that affects the stock volatility, even the company, are very interesting things to think about and things that different models provide very different predictions for.
Yeah, and Kathleen, going back to your question about retail investor interest in this space with direct listings in particular. So as Michelle pointed out, this is an environment where retail investors may feel, oh, now we can play with the big boys. Now we can play in a game that we were previously precluded from playing in. And that kind of raises the question as, are they kind of, being subjective about the investment that they're valuing?
So I think from a research perspective, we've had a lot of criticism from practitioners that the IPO market is broken. US markets are not conducive to smaller companies going public. With the number of SPACs and direct listings, there are not a ton of direct listings, but certainly the SPAC market. Can we say that the market is fixed? Or can we say, look, some parts of the market have responded to this? We did talk a little bit about needs of investors and firms, but what do you see the market doing moving forward? How do you think this is, are we going to now have a robust IPO market? Or is this just, do you think, a flash in the pan?
Can I go first on this one?
You may go first.
So in some ways, this is the $1 million question, but I also think sometimes this is the second question. And first, we need to really understand the first question, which is, are they really broken? And I'm not sure we ever really got a good answer to that, right? So I think a lot of practitioners go around saying it's broken because of all the regulations. There's too many regulations now and nobody wants to deal with it. And so everybody's staying private. And across a number of academic papers, there is, I would conclude, very little robust evidence to support that conclusion. What appears to play a much larger role is simply the abundance of private capital in the system. You have a lot of capital sloshing around out there, whatever word you want to use to describe it, that is very, very happy to, and eager, perhaps overeager, to invest in these private companies. And these companies are getting very high valuations from these private funding rounds. The owners, in many cases, are negotiating terms that give them much more control than they would have as a public company. And so, is that good or is that bad? I don't know that I could sort of say, just one or the other. I think there are good and bad to it. One criticism that you can make goes back to sort of one of the missions of the SEC that Olga talked about before, thinking about capital formation, but also individual investors. If you go back to the late 90s, individual investors had the opportunity to invest in a much broader set of companies than they do today. Today, those younger, smaller companies are not going public. And that means that the only people that have the opportunity to invest in that set of companies at that stage of the life cycle, are accredited investors, and very frequently large institutional investors. And so when we ask this question, is the system broken? I would love to have more research on sort of the ways that plays a role. On the one hand, you could argue individual investors are better off, maybe because a whole lot of those very small young companies that went public did absolutely horribly. Most of their investors were retail investors and they lost a ton of money. So maybe it's good all of these companies aren't going public anymore. On the other hand, we should have the availability for people to invest in a lot of different things. So anyway, I'm going to say, I know I didn't answer your question, but it's sort of.
No, that's fine. I could talk about, whether the SEC should, play mommy and daddy and restrict investors and accredited investors till the cows come home, because I do think this issue really impacts capital formation. I mean, we do allow investors to do crowdfunding, but dear God, it's so small, nobody can really put a lot of money into it. And the disclosure requirements are actually pretty high. So, Olga, what do you think about this?
Yeah, I mean, so I think it's, in general, when this question is being discussed among practitioners, among politicians, among everyone but economists, there's this kind of there's this oversimplification, and we cannot separate the quantity of public investment opportunities from the quality. So we have to think about, so is it a problem that so few companies were becoming public? I don't know. We have to think about, should we implement policies to allow more companies to become public? Well, the question is not is more better. The question is, what kind of companies? What are the incentives are the types of companies that go public going to be different? So I play my very limited role in influencing policy at the SEC, but to the extent that I do, I kind of always try to highlight for people that, it's not necessarily just about the number of opportunities, but what those opportunities actually are. But I'm completely sympathetic, Kathleen, to your paternalism point. Should the SEC be choosing, should a financial regulator be choosing what constitutes a quality investment? Or should we just have, give access to investors to decide for themselves? I think, however, the key role of the SEC here is make sure that the investors have sufficient information and disclosures.
Yeah, disclosure goes some of the way, right? It does. So I want to take, we have about 9 minutes left. First of all, if you have questions, we'd love to have them now. This is going to be the time to do it. But I want to, because it is a PhD symposium, and this issue of capital formation is one that continues to evolve and be of importance to both regulators and academics, to talk a little bit about where you think these sort of rising academics should be looking or thinking about in their research. So from your perspective, Olga, can you talk just very briefly how research is used at the SEC and how important it is to the policymaking process, as well as any ideas you might have for them to look at? And then Michelle, I'll turn it over to you as a having been an associate editor in many journals, of sort of how students can think about the publication process for their research and what ideas you might have. So
yeah, so economists at the SEC do a variety of different things. What I do is, evaluate the costs and benefits of the rules that the SEC puts forth. And for that, of course, academic research is crucially important to us. So when doing an economic analysis, we often appeal, to academic research that studies these particular questions. So to the extent that, what the market looks like with respect to returns to investors, with respect to how markets react to information, all of these kinds of things we rely on academic studies for. With respect to capital raising, I think kind of a focus that would be of interest to the SEC would be kind of touching on what I mentioned before, really trying to think about how companies sort into these different methods of raising capital. What kind of, so I think in finance in general, there's been this focus of identifying causality, in controlling for selection, identifying causality. I think there's so many interesting questions left on the table. Fixing causality, identify the selection. So this is kind of where I think, is it a separating equilibrium where just certain type of companies are going to choose one or the other? Why? What kind of companies are going to do that?
Terrific. Michelle?
I think I would piggyback on that. I think that, in this space, that the good thing for all of us, and certainly all of you, is that these new developments in the market give rise to new research questions and new things that we want to understand. I find fascinating the way that contract terms and SPACs are changing to go towards a more long-run equilibrium. I mean, that's just like private market figuring things out before the regulator can figure out the problem. No offense to the SEC, but like it's already happening, right? And so digging into the details and looking at those contracts and understanding how things are changing, I just think that's fascinating. Thinking about people's incentives, right? Like why, to get to the question Kathleen asked before that I don't know that either one of us really answered maybe as well as we should have, probably because we don't know yet, is, why are these new methods coming up now, whereas they tried 20 years ago and didn't succeed? Are there any trigger events that we can understand? Is the type of company changing? Yeah, I would challenge yourself to ask big picture questions. I do think that editors, they want big picture questions. Try to avoid, I always say, if you start with a little question, you have no chance of getting a big paper. If you get a big question, you at least have a chance at a big paper that might be whittled down someday, but like you might as well start with something, right? So don't be so, and again, this echoes what Olga was saying, but don't be so concerned with causality that you think I have to ask this very little question because it's the only place that I can really achieve causality. Ask the big questions, get new data. There are, your sort of group as a whole, your generation has these fantastic data skills that enable you to uncover things that we don't know yet. And there's so much to learn there. And then a personal plug that I just feel very passionate about is regulation is so often set, as Olga said, based on academic evidence, but because most academic evidence is published based on the largest companies, because that's where we have the most machine readable data, we know still so much less about how some of these regulations affect smaller companies. And there are a few papers in this space, but it is an area where I really think there is a lot more that we can learn. So I would sort of put that out to all of you. It does entail data collection often, but don't just restrict yourself to the S&P 1500 companies. There's a lot more companies than that out there. So I'll stop there.
Yes, and I also encourage you, since this is, we have an opportunity for you to learn a little bit more about the SEC, is that, if you occasionally just go on the website and there is a rulemaking that is of interest to you, you can provide your research to the commission through the comment process. You can send them a paper and they can be aware of it. Another way to get practitioner insight is to also read some of those comment letters. So sometimes we'll work on a project, we don't really have a practitioner we can talk to, but maybe if you're looking at something like we had a paper on the Jobs Act in our prior session, you can read the comment letters with respect to what practitioners are saying about the provisions of the Jobs Act. And so that will give you some insight into how markets work. So this has been just a fascinating discussion. Wonderful job, Olga and Michelle. We really thank you. If there are not any more questions, I'll give 1 second. Type it fast or raise your hand. All right.
In addition to the comment file, I would also plug the roundtables that the SEC holds.
Oh yeah, and of course, I will plug my conference with the SEC. We have one every year, and it closes in November, where we do 8 papers. We accept 8 papers, so hopefully we'll do another one this year. And so look for that call for papers. But I think someone wanted to ask a question, maybe. No. All right, I thought I heard someone do it. Well. Thank you both very much. And
thank you, Kathleen.
We'll clap virtually.
Good luck to all of you. I hope you enjoy the conference. It's been a great conference so far.
All right, bye now.
Okay, bye, Kathleen. Bye, everybody.